Hey, it's Matt Decker with Leverage Wealth Management. I'm doing another video series here, and this is the first in probably two or three, and we're going to dive back into whole life insurance. And there's a bunch of reasons why we're going to dive back into whole life insurance, but the main one is because I keep getting questions about it, number one, and number two, I get a constant stream of comments and emails from whole life insurance agents that think I don't know what I'm talking about. And so I figured I would just go ahead and air their dirty laundry out in front of everyone for the world to see, because there are some really easy misconceptions about whole life insurance. And it's so easy to point it out and get people pointed in the right direction as it relates to whole life insurance and a couple of the biggest misconceptions. So really the only thing that we're going to talk about today is going to be dividends. And the reason that we're going to talk about dividends is because it's probably the most misunderstood aspect of whole life insurance. And the reason it's misunderstood is because, number one, whole life insurance doesn't have a dividend. Not in the real sense of the word dividend. A typical dividend, everybody kind of understands how a dividend works because they think of a dividend in the form of a stock dividend or a dividend from a company that they own, where someone declares, as an example, a 5% dividend. And if you have $100,000 invested in whatever it is that's declaring that 5% dividend, you're going to expect $5,000 and you're going to get $5,000. That's how a dividend works. That is not how a dividend works in whole life insurance, which is one of the reasons that dividends are so easily misunderstood and misrepresented. What it should be called in whole life is really a return of overpaid premium. Because if you have, let's just say, a 7% dividend and $100,000 in cash inside a whole life insurance contract, you do not get $7,000. That's not how it works. It's not a real dividend in the way that you would normally think about dividends. So this video is only going to do two things. The first thing that we're going to do is we're going to look at the actual historical published dividend rates from several of the top whole life insurance carriers. This data is widely available. You can find it a number of places. All it does is show a bunch of different companies and what their declared dividend rate was for the last, say, 25 years. So we're going to look at that, number one. That's the first thing we're going to do. The second thing we're going to do is we're going to look at a study that looks at the illustrated internal rate of return of all these products, and it compares the illustrated rate of return to the actual rate of return. And what you're going to find is that, number one, the illustrated rate of return on all these products is nowhere near the declared dividend rate. Okay, so there's already a discrepancy between the internal rate of return of the products you're being shown and the dividend rate that is being declared to you. There's already a disconnect. The second thing it's going to show is that the actual rate of return, not the illustrated rate of return, but the actual rate of return for policies that have been around for 20 years, is nowhere near the illustrated rate of return. So not only is the illustrated rate of return on these products not close to the dividend rate, but the actual rate of return of policies that have been on the books for 20 years is nowhere near the projected rate of return. When we look at the numbers, it's going to be really easy to understand and digest, but let's go ahead and start by just looking at the historical published declared dividend rates from some of the top carriers that are out there. So what you're looking at here are the historical whole life insurance dividends from 1988 to 2016. And what it's doing is it's just showing you these companies here: General American, Guardian, John Hancock, Manulife, Mass Mutual, MetLife, New England Financial, New York Life, Northwestern Mutual, Penn Mutual, Phoenix and Sun Life, some of the biggest carriers that are out there. It's showing you these carriers and their declared dividend rates for every single year from 1989 all the way up until 2016. And what's really interesting about this chart, number one, is you'll notice that back in 1989, look at these declared dividend rates. Just about every single one is over 10%, besides Penn and Sun Life. Everybody else is over 10% declared dividend. Now, John Hancock didn't have a product in these 3 years, but that's the only one that's an outlier. Every single product had a declared dividend rate of 9.5 or better. So right off the bat, if you're a client and you are just being introduced to whole life insurance and someone is trying to sell you one of these whole life insurance policies and they tell you you're going to get a 10% dividend, what are you thinking? Immediately, you are thinking that you are going to get $1,000 in dividends for every $10,000 of invested monies. That's what you're thinking, because that's how a dividend works, right? You get 10% of whatever you have invested. So if every 10,000 you invest, you're going to get $1,000. That's what you're thinking, because that's how dividends work. But that is not at all how whole life insurance works, and we'll get to that in a second. The one that I really want to key in on, not because I want to beat them up or anything, is Mass Mutual. I actually think Mass Mutual is a really good company, and if I were inclined to purchase whole life insurance, I would probably purchase it from Mass Mutual. But the reason that I want to key in on Mass Mutual is because their declared dividend rate of around 7% is the one that I hear about most often. People telling me, Matt, I have a 7% rate of return on my whole life insurance policy. And really what they're talking about is this Mass Mutual product that has a dividend rate that's been in the sevens back since 2003, really. So back in 2003 up until now, Mass Mutual has been declaring a 7% or higher dividend rate. So let's just take Mass Mutual as an example. We could take any one of these companies on this list as an example, but let's just take Mass Mutual. So in 1989, the declared dividend rate was 11.15. 5 years later, in 1994, their declared dividend rate was 9.3. 5 years later, in 99, it was 8.4. 5 years later, in 2004, it was 7.5. And it's basically been in the sevens ever since. So you're looking at a dividend rate of between 11.5 to 7% for the last 20 plus years, 25 plus years. So let's put this into terms that everybody understands. If you had an investment, let's just say it was a stock portfolio or a mutual fund portfolio. If for the last 25 plus years, every single year, you never got a 0% rate of return, because you'll notice here there's a dividend declared in every single year. There's no zeros. You got a return every single year for the last 25 plus years, and that return fluctuated between 11.15 and 7%. It was never higher than 11.15 and it was never lower than 7. So every single year, 25 plus years, returns between 7% and 11.15. What type of rate of return on the product would you be expecting? It's not a trick question. In fact, it's a really simple question. You'd be expecting a return somewhere in the middle here, between 11.15 and 7%. You certainly wouldn't expect your rate of return to be less than 7. How could it? You never earned less than 7. And you wouldn't expect it to be more than 11.5. How could it? You never earned more than 11.15. So you'd expect something in the middle. You'd probably expect something in the 9 or 8% range, somewhere in there, 9 to 8%. That seems reasonable. And this is the problem, because most people that purchase whole life insurance, this is their expectation, something like this. Now, obviously, it's different now because they're being quoted 7, but you get the idea. They're quoted a 7% dividend. They're expecting something like a 7% rate of return. The problem with whole life is not how it works. The problem with whole life is how it's perceived to be working. If this is your perception, over the last 25, 26 years, you should have got between 8 and 9% because every single year was between 11 and 7% dividend. That's the problem with whole life, your perception. So let's look at how these policies actually performed from an internal rate of return standpoint, net of fees, over the last 20 years, because we have that data. It's available. You just have to look for it. So here is that data. And what you're looking at is 20-year historical performance from 1990 to 2010. So 20 years, policies that have been on the books since 1990, tracking them through 2010. And you'll notice it's basically all the same companies. Country Financial, Guardian, Mass Mutual, MetLife, Mutual Trust, New York Life, Northwestern Mutual, Penn. All the big boys are on this list. Now, we specifically pointed out Mass Mutual as the company that we were going to look at. The reason we pointed them out is not because they're really any special or any different or the worst example. They're one of the better examples of a whole life insurance company that has historical dividend rates. They're stable. They're very highly rated. If I were to buy a whole life insurance policy, I would look at Mass Mutual. That's why we're looking at Mass Mutual. It's also because when I hear about stated dividend rates being up in the 7% range, 7% returns in a whole life insurance contract, nearly every single time someone is talking about Mass Mutual. So that's why we're looking at Mass Mutual as an example. So here's what I want to focus on right here, this total cash value column. And we've got 4 columns here that are just really, really important to understand and be able to internalize. So the first thing that we're looking at is if you looked at the illustration that was given to a client in 1990, if you look at that illustration, 20 years down the road, what is going to be the illustrated cash value? That's the first column. The second column is based on this cash value that was illustrated, what is the actual illustrated internal rate of return? So if you were looking at the original illustration given to a client in 1990, what is the illustrated cash value and the illustrated internal rate of return? And then the second 2 columns are, okay, so we know what it was in 1990, but what actually played out? What was the actual cash value 20 years later? And what was the actual internal rate of return 20 years later? So right off the bat, you'll notice a problem with this Mass Mutual contract. Looking at these first 2 columns, every single year, the dividend rate that was declared was higher than 7%, and yet our illustrated internal rate of return is less than 6, 5.94. Now this is what was on paper. So right off the bat, you know that that's not a dividend rate, because your illustrated internal rate of return is nowhere near the declared dividend rate. Okay, but that's only the first part. And our illustrated cash value was $183,000. Okay, well, what actually happened? What actually happened is not that you got $183,000. What actually happened is that you got $142,000 in cash in 20 years, 142, and your actual internal rate of return on that money, the 142,000, if you did an internal rate of return calculation on the premium that you paid and the cash that you ended up with, is 3.74%. 3.74%, nowhere near 7, 8, or 9, which is what most people are thinking they're getting when they're buying whole life insurance. Now, it's not their fault. Okay, it's the fault of the agent who sold them the whole life insurance, who set the expectation that the dividend rate is the same thing as an actual stock dividend, that the dividend rate is the same thing as rate of return. Those 2 things could not be further from the truth, and this shows exactly that. The illustrated IRR, 5.94%. How can that be possible when we look at the declared dividend rate of Mass Mutual and every single year, 11, 10, 10, 9, 9, 9, 9, 8.4, 8.4, 8.4, 8.4, all the lowest it gets is 7%. I take that back. The lowest it gets is 6.85 for 1 year, and then it shoots back up to 7%. How could it be that the illustrated rate of return is 5.94 when every single year is well above that from a declared dividend standpoint? And how in the world could it be that the actual rate of return for policies that have been on the books for 20 years is only 3.74 when our dividend rates are 2 to 3 times that? Well, the answer is really simple. All these declared dividends, these are not dividends. They're not dividends. Not in the traditional sense of the word. This is excess premium being returned. Now, why they get to call it a dividend, I don't know, but it's not a dividend. It's return of excess premium paid. So that brings me to the end of this video. And in closing, I only have 3 points. Number 1, the declared dividend rate is not your rate of return. I think that we've pretty much proved that without question. You can take your policy, you can do a quick just calculation, divide your cash value by the previous year, take out the premium, and you'll see that your rate of return is not the dividend rate. That's very easy to do. The second thing that I think we've kind of covered and that I need to make sure everybody understands is that your illustration is not guaranteed. There are guaranteed values on the illustration, but when you're looking at the cash column and the death benefit column, typically it's on the far right hand side. None of that is guaranteed. How do you know it's not guaranteed? Because if it was guaranteed, all these values that we're looking at here in this column, all these values would be the same if it was guaranteed, okay? All your illustrated values would be the same if it's guaranteed. So many people buy whole life insurance because they like the guarantees. Well, your cash, the projected cash is not guaranteed. The guaranteed cash is guaranteed. And the guaranteed cash typically has a return of something like 1%. Okay, so it's not a world beater. You just have to understand exactly what you're buying. The second thing that I want to point out, it's that whole life insurance is not bad. Okay, it's great as long as you know what you're buying. If you're buying whole life insurance as an alternative to a stock portfolio, it is not going to keep pace with the stock portfolio. It's just not. It's not designed to do that. If you're buying whole life insurance as maybe a bond or CD alternative, now we're talking, okay? Because that's about the risk profile of whole life insurance. You can expect between 2 to 4.5%. That is the risk profile, that is the return target of most of these whole life insurance companies. 4.5%, 5% at best, but I wouldn't count on 5. So if you're buying whole life insurance as a bond alternative, I say go for it all day long. That's exactly what it's designed to replicate. If you're buying whole life insurance because you think it has a 7%, 8%, 9% rate of return, I'd say that you're working with somebody that's not giving you the full picture. The next thing that we're going to talk about as it relates to whole life insurance is projected income, because not enough people talk about projected income out of whole life insurance. And so you can be looking forward to that video in the next couple days. If you'd like your current cash value life insurance policy reviewed by me, you can always go to our website, leveragedwm.com/IUL review, leveragedwm.com/IUL-review. You go there, you take the really short quiz. I think it's 3 or 4 questions. You fill out the form, and then I'll be in contact with you to schedule our one-on-one in-person 30-minute review. It's super simple, no pressure. It's just an opportunity for you to ask questions about what you have and if it's the right fit for you and your goals and what you're trying to do. And of course, as always, the way that you can support this channel is you can like these videos, you can share these videos, and you can subscribe to our channel to make sure that you're up to date on all the videos and content that we put out. The goal here is to be a place for unbiased educational material as it relates to cash value life insurance, because there's so much misinformation out there. There's so much selling of cash value life insurance, and there's very little buying of cash value life insurance. My personal opinion is if people really understood how cash value life insurance works, it would be bought, it would not be sold, and clients would be very happy with what they bought. Thanks for watching this video. This has been Matt Decker with Leveraged Wealth Management. If you want that review, go to leveragedwm.com/IUL review. I will link it in the description and the comments below. Let me know what else you want to see from me on this channel, whether it's policy reviews, carrier reviews, complicated topics like premium finance, deferred comp, split dollar. You let me know in the comments below and I'll get to work. Thanks so much. This is Matt Decker. We'll talk to you soon.